Welcome, ladies and gentlemen. I'm delighted to welcome our next presenter to the stage. Jay Mintzmeyer is a renowned maritime shipping analyst who directs the Value Investors Edge, VIE, research platform on Seeking Alpha. He's a frequent speaker at industry conferences and is regularly quoted in trade journals and has hosted popular podcasts featuring shipping industry executives. Mr. Mintzmeyer also hosts a regular virtual investor forums, which are a must attend for anyone interested in the shipping and infrastructure industries. Jay, we're ready when you are.
Hey, good morning, everybody. Thank you for joining this webinar. I'm excited to share the latest shipping updates with you. Apologize for the drab background. I'm in a hotel room in beautiful Colorado Springs here. I wish I could show you the background, but unfortunately, it does mess with the screen a little bit. So today, what we're going to talk about is the shipping markets, and I'm going to share a few top picks from our research platform. I'm the head of research at Value Investors Edge, which is a boutique research platform hosted on Seeking Alpha. You can follow me for free on Twitter at Mintzmeyer. I tweet once or twice a day with the latest shipping updates, sometimes one of our new research reports or something like that. We also have 2-week research free trials that are open through Friday. You can go to mintzmeyer.com and access that directly. So the first thing I want to do, a little bit of an appetizer, is to amuse-bouche, if you will, is to share the past performance since we've been on Money Show. We've worked with Money Show Expo for the last 2 years or so. And about once a quarter, we come on and we share 3 or 4 top picks and some market updates. And so the first time we came on was 2 years ago. And this was opportune. It was kind of in the depths of the COVID crisis and shipping was not popular. We said there was outsized return potential in maritime shipping. And the average return of our 5 picks, and these are free, 5 public picks. You can actually go to my YouTube channel and see all these videos and check to make sure I'm not making things up here. And those 5 picks returned 38.5% in 4 months. And you might say, well, Jay, why 4 months? That's kind of a weird time frame. Why not 2 years? They've actually mostly tripled in 2 years. That's because we came back on again. And I'm not going to go through each one of these. It'll take us all day. But you can see that about once a quarter, I came on and shared the top picks. And we outperformed the S&P by huge amounts 4 times in a row. And then we had a 6% underperformance last October. Then we had a 52% massive outperformance last December when we came online. And then today, I updated these last night and we underperformed by 0.9%. And it's funny because it's been a tough summer for shipping. And yet we still basically tracked the market average. And it's funny, the day before we were actually beating the market by 2%. So it's basically tying the market. And I think that's pretty good considering all the volatility and the macro. So what does that mean? Well, over the last 2 years, 2 years and 1 month, if we want to be precise, if you would have just followed the free public picks that we shared here on Money Show Expo, you would have outperformed the market by 225%. Of course, there might be a little slippage in there, but that's a massive number. And you can go to YouTube and see these videos and see that those picks were there. So stay tuned. We're going to share our top picks here towards the end of the presentation and along with each segment. So today, I'm going to share a little bit about our research background and our approach and how we're able to outperform the market. I'm going to talk briefly about the overall kind of macro setup here with shipping. And then I'm going to talk through 3 different segments, tankers, containerships, and dry bulk. Real high level views here, about 3 to 4 minutes per segment, and 1 top pick per each segment. And then we'll review those picks, and I want to open it up for Q&A. So I'm hoping we'll have at least 5, maybe 10 minutes for Q&A. So if you're thinking of something, just write your question and put it in the chat, and we'll try to get to it here near the end. So the one thing we do, people always say, Jay, why do you focus so much in shipping? It's such a small niche area. And that's exactly why we focus on shipping. We don't have to compete with the folks like at Goldman Sachs or Morgan Stanley or anything like that. And we're able to focus completely in our lane. We have a team of 4 people. And all we do is shipping and maritime infrastructure and energy infrastructure. So it's very focused. And it's really the secret to our success is the level of our focus, the level of our intensity, and the niche of our market. And so we have model portfolios that we share with our members, and that's available on Value Investors Edge. A reminder, we do have free trials available, mintzmeyer.com. You can sign up today. That's available through Friday. These model portfolios are long only. No options, no leverage, and they're updated once a month. So they're pretty easy to track. We don't move them around too much. We want to make it as simple for our members as possible. But in 2021, we were able to post 190.8%, so 191 basically in the speculative model. That's no leverage. That's just regular stocks, and 81.7% in the value. And so this is a chart that kind of shows how 2021 went. And you can see that, people might say, well, Jay, that's because shipping did so well. And, shipping did well. That's the purple line here. But you can see that we massively outperformed our industry. And then the black line here is the Russell 2000. So 2021 was a fantastic year for us. 2022 has also started out very well. So far, as of last night, Our speculative model is at 42.3%. And keep in mind, the S&P 500 is down 20% this year. So those are pretty huge numbers. And the value model, the more conservative one, is actually outperforming this year, which makes sense. In a more volatile market, you would expect the more conservative portfolio would probably do a little bit better. And that's the chart this year. And so this year, we're closer to the industry average, but we're smoking the Russell 2000. It's not even close. And last thing, I know you're tired of seeing performance stats, but I just want to iterate the importance of focusing on a niche sector. This is our performance over the last 7 years. And you can see the shipping industry is tough. If you thought shipping industry is a difficult place to be, you're not wrong. It's 6% annualized return over the last 7 years. Lots of years where it was negative. This is the Russell 2000 here, 8.4, not too bad. S&P 500, 12.3. That's actually a pretty nice return from the main market. But our portfolios, model portfolios and trades are 44.2%. So of course, a past performance, no guarantee of future results, but I'm very proud of the work that our team has done and the performance we've been able to post. So thanks for your patience as we went through that. I want to now focus on the overall shipping market and some of the catalysts that we see. So in 2021 and last year, it was a gangbusters year for us in terms of trading and investing. And that's really because all these equities were like coiled springs. They fell so much in 2020, really for no reason, just because people were afraid of the macro headlines, but the actual underlying cash flows were strong. The supply chain crisis happened. We had a tanker floating storage boom. We had all sorts of things that brought a lot of free cash flow to these firms, and yet the stocks, went down and down and down. And so in 2021, when the market finally realized how strong these companies were, how good their balance sheets were, how low the multiples were, the stocks exploded upwards. We also had the start of the energy crisis in Europe and Asia. Last year was more so due to weather, the La Nina effect. This year, of course, is due to Ukraine and the Russian gas. But we've been in a multi-year sort of energy crisis here, and that has really helped shipping as well. In 2021, basically 2/3 of the stocks were winners, and we were fortunate enough to be in basically all the winners there. 2022 is much more volatile. It requires much more active management in terms of stock picking and such. We have the war, of course, going on. We have the inflation. We have the supply chain disruptions that started in early 2022. However, despite the big gains in 21, the equity market valuations are still very attractive. In fact, they're still among the lowest we've seen in the last couple decades. And a big reason for this is because the balance sheets of these firms have never been stronger. If you look back at the last strong cycle, which would have been 2007, 2008, those balance sheets were very rickety. We had a decade downturn basically after the global financial crisis, and the balance sheets there were really rough as well. Lots of bankruptcies, restructurings. Right now, most of these firms have 10%, 20% debt. Some of them are net cash. So these are the strongest balance sheets we've ever seen. Even if rates really fall, we're not going to see these companies be in any sort of distress. The companies that are doing well are ramping shareholder returns, big dividends, big repurchases. Almost every single firm that we follow now has an active repurchase program, which is unprecedented. Most of them have dividends as well. Most of them are variable. Some of them are fixed. And even though this has been a tough year, it really feels like it's been a tough year, doesn't it? But the shipping stocks on average have outperformed the S&P 500 by 60%. And I think, folks have told me, isn't it so difficult to be in shipping? Isn't this the wrong place to be? And I'm like, well, we're 60% over the S&P 500. I mean, this is, we're doing really well. And it's because of the fundamentals here. These companies are very cheap. And on a risk reward basis, some of the top picks we're going to share today have substantial upside. In fact, some of the risk rewards are among the better we've ever seen, which was surprising. So right now we have some tailwinds that are sort of helping us out. And one of the reasons why we're outperforming so much this year, first of all, we have surging cash flows and shareholder returns. I've talked about the strong balance sheet, and that strong balance sheet enables strong shareholder returns. We've been very well positioned for inflation. Shipping is the place to be if there's high inflation. If you think about it, the rates are nominal and the vessel valuations are nominal dollars, and those go up with inflation. But a lot of the debt is fixed or swapped out. So the debt value, real value goes down. So you have this like multiplied effect, especially if there's some leverage going on, where shipping stocks benefit enormously from an inflationary environment. And that's going to ramp up your net asset value and your earnings per share. And of course, that's inflation. So it's not something we cheer necessarily, but if you're trying to be somewhere for inflation, shipping has been one of the places to be. There's huge environmental regulations that are going to start in January, and that's only, 4.5, 5 months away now. And those are going to be a 5-year rolling impact, and it's going to slow down the fleet across the board. And the larger ships are going to be impacted a little bit more than the smaller ships, but this is a tailwind and upcoming catalyst that's going to help the shipping sector for the next 5 years. And then finally, we're waiting on China here. China has been disappointing all summer. The property sector has been rickety. They've been playing a lot of defense. They're still doing zero COVID. We're waiting for Xi Jinping's third term to start here. But once China really pushes the gas pedal back on stimulus, pushes down on the gas pedal, I think that's going to be a nice tailwind for a lot of shipping. And that's something we really haven't seen. China's been kind of cautious and slower the last couple of years. But there's headwinds and there's things to be concerned about. And we really need to talk about those as well. So first, most obvious one is the slowing global economy and likely European Union recession that's coming up. That's obviously going to be bad for the consumer focused stuff. So think about like container ships and such. Most of container shipping and a lot of shipping in general does correlate somewhat with global GDP growth. So it's going to be difficult to see that top line growing if the entire economy is in recession. And the firms that have high spot exposure, so firms that are fixing their ships month in, month out, are going to have a lot more risk. We definitely prefer the firms that have long-term contracts. So there's a lot of long-term contracts, for example, in container ship leasing companies. There's a lot of long-term contracts in LNG. That's a little bit more of a stable place to be. Inflation, of course, is also crippling the buying power. And this has been, slowly starting to impact the market throughout the late 21, early 22, and we're really starting to see it now. There's not as much government stimulus going on as well because the governments are focused on inflation. You can't really have stimulus while trying to fight inflation. So, and the third trend, the third piece of that is folks are, as we emerge from COVID, there's been a lot more travel this summer and a lot less, buying gadgets and stuff like that. So the initial setup of this, we talked about this 6 months ago, was this is going to be bullish for oil tankers. So we were starting to get bullish on oil tankers 6 months ago, and it's going to be bearish for containers. It's going to be really hard to fight that macro. But the risk is that if inflation gets out of control, then it's bearish for every segment. So this is something obviously we're tracking, and the CPI comes out next, I think next Wednesday, September 13th. And of course, we're hoping for a moderating number on that. And then finally, disruption from conflict is actually bullish for shipping. It's never something I would cheer or be happy about. But the Ukraine situation has been, for most segments of shipping, it has been pretty much a positive for rates because it disrupts the ships and slows down the flow of things. But any sort of obviously World War III or conflict outbreak that would spread beyond the region is very bearish. And so we're watching that closely. Any sort of major escalation involving NATO, even things like NATO expansion and building up those tensions can be bearish in terms of macro, if nothing else than sentiment. So these are the three areas that we have to be watching closely. We have been this year, and I think investors need to keep both eyes open on these. So now I want to turn to the sectors and spend a couple minutes on each one and share a top pick. So with tankers, we have a massive ongoing recovery. And it's great to see, because if you go back on the YouTube videos and look at our previous presentations, we were talking about the recovery potential and how it was right around the corner. It might take 6 months, might take a year, but it was right around the corner. And so these crude tankers, they just got destroyed by COVID-19. You had global demand crashing, right, because of all the lockdowns. And at the same time, OPEC reduced their supply. So the tankers were squeezed on both ends. And it's just a supply demand market, and the supply of oil is down, the demand of consumers is down, but all the oil tankers are still in the ocean. So the rates collapsed. It was terrible for them. And it took 2 years, 2 full years to start recovering. But finally, in 2022, we had three things. First, we had demand recovery. Consumers are back out driving around, taking airplanes, things like that. We had OPEC exports ramping back up, almost back to full capacity on exports. And we had President Biden, the Biden administration, authorized the release of U.S. Strategic Petroleum Reserve reserves, which went straight into the export market. So oil tankers were benefiting on every single level. And then finally, the Russia-Ukraine conflict added all sorts of inefficiencies, especially for product tankers, gasoline, diesel, that sort of thing. And then there's a talk of an EU oil ban, which is still kind of tentative, but it could start as soon as January. And we're going to show you some slides on what sort of impact that could have. Our top pick in tankers, we like a company that trades at a discount to NAV, has strong corporate governance, and has a solid balance sheet. And they're doing active repurchases. They just announced they did 20 million repurchases a couple of weeks ago. It's International Seaways, INSW. It trades just a little bit over $30. I think it's about 31-ish today. And we believe it's worth in the mid 40s. So a nice upside there. And then here's a list of other tanker firms. So I mentioned that EU oil ban, and of course, that's still a little bit tentative. It hasn't been fully agreed by everybody, but it's tentative to start in January. If that happens, we're going to see a major rerouting of oil because all the pipeline and ocean going oil that comes out of Russia into the European Union is going to have to reroute all the way back over to Asia. Meanwhile, Europe is going to have to source their oil from somewhere else. And right now they're sourcing it from their neighbor right next door. But now they're going to have to start getting oil either from the Middle East or from the United States or from somewhere like Brazil. So it's adding ton miles on both sides. Russia has to push their oil further away to Asia, and Europe has to pull their oil from farther away, like the United States. So this will drive massive demand for oil tankers. And this is sort of, so that was the previous setup, and this is sort of the rerouting. And these are older slides that you're now put these together in March, but the same net impact will happen if that EU oil ban goes into effect. So then we're going to see a lot of oil price rises around that as well. So this is a major thing. It hasn't been fully agreed to yet, but it would be a major bullish catalyst for oil tankers. And then the really nice setup with oil tankers that makes us believe this rally could last a little bit longer, it might not just be a flash in the pan for 6 months, is the fact that the order book, the new tankers coming online, are the smallest in history. And this slide's a little bit old, but the reason why I stuck with the old slide is because it's still basically current. There's only been 2 additional VLCCs ordered all summer in the last entire year. Usually there's 40 or 50 ordered in a year. Last year, there's been 2 VLCCs ordered, and there's been about 4 to 5 Suezmaxes ordered. And usually there's, anywhere from 40, 50 of those as well. So the order book is basically tiny, the slowest it's ever been. Not only is the order book the smallest it's ever been, the older ships are the highest percentage they've basically ever been. 25% of the VLCC fleet is over 15 years. 15 is when you start to get kind of aging and you need to start thinking about recycling. And 20 years is when you're really in trouble. It costs you a lot more money to run the ship. You really have to start thinking about divesting. And a lot of oil majors won't even deal with tankers that are over 15 years old. And oh, by the way, in January 2023, those new regulations, environmental regulations, start kicking in. So this is an extremely bullish supply side. And we already mentioned how the demand side can get kicked into gear by that EU oil ban. So tankers are looking really good. We think that run can last. Container ships, these are, I like to say, misunderstood cash flow machines. And they're misunderstood because everybody is trading these stocks based on the macro headlines and sentiment and how they're feeling today and if they have a stomachache or not. And they're not looking at the fundamental underlying cash flows these firms have locked in. Now, I'm not talking about the liner firms like Maersk or Zim or CMA CGM. I'm talking about the companies that actually own the underlying vessels. And these vessels have been leased out over the last 2 years, anywhere from 3 to 5 year contracts at basically record high rates. And those contracts are rock solid. People say, oh, those contracts will get renegotiated. Look, I've been following the sector now for almost 15 years, and I've backdated this for 25 to 30. Even during the peak of the global financial crisis, these contracts are impossible to renegotiate outside of like a bankruptcy. Obviously, if the company goes bankrupt, they can't pay their contracts. But if you look at the liner companies, they have the strongest balance sheets in history. A lot of them are almost net debt free now because of the bonanza they've enjoyed in 21 and 22. So the liner companies are very, very strong. They're still earning a lot of money. And these ship leasing contracts are good for 3 to 5 years. So these leasing companies are actually going to increase net cash flows, free cash flows, earnings, dividends over 2023 and 2024, even if freight rates come down. And that's why I say they're misunderstood. Because if you look at the stock price of some of these, they've all came down this summer. And it just makes no sense to me, especially since they're just signing new leases as we're speaking. So the beautiful thing about this is even though the freight rates and then supply chain crisis is kind of peaked and is kind of over, new ships hitting the water is very limited until the middle of next year. It's taking that long for a new ship that's ordered to hit the water. So we're not going to see an oversupply really until next year sometime. Consumer demand's obviously dropped in the EU and the United States, but the congestion levels are still pretty high. So still holding those rates up. And then finally, I've kind of hit this on every single segment, but those environmental regulations are going to come in starting in January. And container ships are by far the biggest gas guzzlers. They use the highest amount of bunker fuel, and they're going to be the most impacted by these regulations. And selective firms, the ones that we really like, have built up massive contract backlogs. One of these companies has contract backlogs extending into the 2030s. And that's what our top pick in the overall container ship sector is. It's a company called Textainer Group, TGH. They lease the actual metal boxes, the 20-foot and 40-foot boxes. And these are done on anywhere from 8 to 13-year leases. And they're done. They've already signed all their leases. They're not growing anymore. there's no demand to order new containers now. That was 2 years ago. They're all done with this. And so all of their free cash flow, a little bit is going to paying down debt, of course, and all the rest is going to go to shareholder returns. So this company is spending almost all of its free cash flow on either dividends or repurchases. They're not growing anymore, and they have contract backlog, which extends until the 2030s. And we believe it's worth about $56 per share, and it trades just under 30. So massive upside for such a safe, boring company. Really surprising that we even have that opportunity. And those are some of the other container ship companies there at the bottom. So one thing I want to underline here is the discipline across this sector. It's almost like the pivot and transition we had in global airlines. Remember, global airlines for decades were a terrible, terrible business. And then at some point, there was deregulation and lots of competition, lots of bankruptcies, lots of consolidation. And now global airlines are actually a pretty strong business. And that's kind of what happened here with container ship liners. The top 5 liners, that's MSC, Maersk, CMA, Costco, and Hapag-Lloyd, control 65% of the market, which is pretty phenomenal because a decade ago, the top 5 were like 35% of the market. So massive growth in the top 5, and the top 10 control 85%. And you know, Zim is a big one. It's been a popular stock, but you know, Zim's 2% of the market. So that's pretty phenomenal to show you how concentrated the power and control is in the top 10. And what's important for that is the discipline. How are they going to control their routes? How are they going to deploy their ships? And the same kind of transition we saw in global airlines with alliances and cost control, we're seeing that with liners. In fact, 2 major liners control basically all the market. As I mentioned, these stocks trade on this mainstream macro narrative, which is very bearish. And of course it's bearish, and nobody's denying that. And every time you turn on, you know, the news, you see, you know, freight recession, supply chain easing, you know, spot rates are coming off. But if you look under the surface, you see these container ship owners are still signing very strong leases. In fact, there was a lease signed just last week by one company. They signed their ships from 2024. So it wasn't even for like now, it was 2 years in the future. They signed their ships from 2024 to 2029 at 43,000 a day. So almost record levels. So there is still phenomenal strength on the ship side of the market. And the congestion is still going on. It's just not in LA and Long Beach anymore. It's in the US East Coast, it's in Europe. And right now, though, what's hurting kind of LA, Long Beach and bringing these ship rates down is we have Chinese lockdowns on one hand, we have a weak US consumer on the other. So macro is very challenging, especially sentiment driven macro, very, very tough. But my argument here on the bottom is that all of this is already priced into the stocks 2 to 3 times. And so once folks start actually paying attention to the underlying fundamentals and start looking at the earnings, the free cash flow and the dividends, these stocks are going to reprice, and they're going to reprice violently. And I think we're going to see that within the next 6 months, if not sooner. We're going to see some of these stocks anywhere from 50% to 100% higher. This is the freight rates in context. This is 3 years of freight rates. So people say, well, freight rates are coming way down. Well, yeah, they had to come down. They were wildly high, super unsustainable. But you can see that even now, after the quote unquote freight rate crash, which happened in the last couple of months, freight rates are still higher than they were in early 2021. In early 2021, people were going ballistic over these freight rates, talking about how they were totally ridiculously high, unsustainable. It was a global crisis. There was going to be Christmas was going to be canceled. And we're at the same rates now, and everyone's saying, oh, they're terrible. So it's just a matter of perception. Zoom out a little bit and realize where we still are. And these are the leasing rates. This is a 24-month chart. And I should have showed you a longer chart because these are all-time record highs. So we're actually, this chart doesn't do it justice of how strong this market currently is. Finally, dry bulk. This is a challenging transition sector, but I think there's a lot of long-term upside in dry bulk. That's like iron ore, coal, that sort of thing. We expected, and we were kind of wrong on this. I got to take the licks on this, but we expected this global reopening and infrastructure spending was going to drive a surge in dry bulk demand. And I think we were right for the first few months. I mean, dry bulk had a really nice run, and we made a lot of money on dry bulk. But we were wrong with how long it would last. This summer, this fall has been very disappointing. I won't shy away from that. And the biggest reason for that is China. China is weak on all fronts. They're still doing zero COVID. The property sector is still a mess. And not only China is weak, but the European Union is weaker. And they're focusing on inflation. They're focusing less on infrastructure, which, think about infrastructure, a lot of steel, a lot of cement, that is good for dry bulk. There's also a lot of uncertainty for this fall on the grains coming out of Ukraine, how much disruption we're going to see. Disruption in shipping is good, but if the supplies get totally canceled, that's bad. You still want the cargoes, you just want a little bit of delay. And so we're not really sure what's going to happen with Ukraine. There was a tentative sort of not a truce, but an agreement between Russia and Ukraine to allow those grain exports to come out of Odessa this fall, but we're still kind of tentative on whether or not that's going to work. There's also a lot of protectionism with coal because of the global energy crisis. So a lot of countries that would export coal are kind of restricting those exports, which means less coal in the water, less demand for shipping. We believe in the longer term, there's two big things that are going to help dry bulk. On the demand side, a lot of these climate change initiatives, new solar power plants, new wind farms, that sort of thing. There's going to be massive demand for iron, copper, cement, all that sort of thing. Electric vehicles, think about how much copper is involved in those. That's going to be dry bulk driven, moving those commodities across the world. That's going to be very bullish for dry bulk. People always focus on things like coal, but they forget about everything else, the iron, the bauxite, the copper, everything else that goes into these projects. And finally, the order book is the lowest in modern history. So supply is very bullish, and we have a promising demand from infrastructure and climate change initiatives. The spot rates are really weak right now. Can't mess around with that one. But the long-term outlook for us is optimistic. We believe that the next 3 to 5 years are going to be very good for dry bulk. Our top pick in dry bulk is a company that has a very, very strong balance sheet, almost no net debt. Which is what you want to be in a challenging market. You don't want a lot of leverage, you don't want a lot of debt. So it's Genco Shipping, G&K, and it's actually headquartered in the US, has great corporate governance and all that stuff. Here's a few other dry bulk firms you can consider. So real quick, here's the rates. This right here, this peak right here is last year, October 8th. So basically 11 months ago. We were at 5,526, 55.26 on the BDI. Now we're at 11.14. So the rates have imploded over the last year. And that's why I say, initially we were correct on dry bulk having a reopening trade, but it did not pan out in 2022 at all. So we were definitely wrong. We were wrong thinking that it would last longer and that China would come out offensively. So this has been very disappointing for us, but we do believe in the long term. Finally, I do want to just review our segment picks and then turn to Q&A. I think we have about 5 minutes. So tankers, we like International Seaways a lot. Containerships, Textainer Group, those 10-year leases, free cash flow surging. And dry bulk, great balance sheet, we like Genco. Our overall top value, we're going to give 4 picks today. The best one, I believe, and I just put a new report out for free on Seeking Alpha, is a company called Global Ship Lease. And that's actually that company that announced that contract I mentioned that doesn't even start till 24 and runs to 29. They completed massive restructuring earlier this year, completely revolutionized and cleaned up their balance sheet. They've signed new charters over the last year that add over 1 billion in EBITDA, which is more than their entire market cap. Their entire market cap is 650 million. So just the last year alone, they've done more deals than their entire market cap, which is pretty phenomenal. Just last week, they signed 6 ships for 5 years, 24 to 29, 2029. So the folks who think that rates are going to fall off a cliff or that liners don't want to obligate these deals, they just signed this deal last week, everybody. So there's a huge disconnect between what's really going on in the market and where the sentiment is at. And the really fascinating thing is that their enterprise value, so everything, the preferred, the common equity, the net debt, is less than just the EBITDA from their charter backlog and worst case demolition of the ships. So there's zero pricing of future upside, future contracts. They could sign a ship at anything in the future, and that is 100% upside to shareholders. So it's a phenomenal mispricing. It's one of the biggest skews I've seen, and I'm just really happy to get to share this with you today. And next time we come on, we can hold me accountable, and we'll see how that one did. And I think it's going to do very well. So our fair value for that one is, we believe it's worth $40, which as I was prepping these slides was 105% upside. I think it might actually, yesterday it went down a little bit, so I think it might actually be a little bit more upside than that. So those are the 4 picks there: International Seaways, Textainer Group, Genco, and Global Ship Lease. We have 3 to 5 minutes, I think, for Q&A. I apologize for running long, but hopefully it was helpful for everybody.
Hey, Jay, fantastic presentation. We've got just a question or two. Let's jump into our first one. What are your thoughts and updates on ZIM?
Yeah, that's a good question to ask. I was huge on ZIM in 2021. We were in front of the IPO, and that was really a life-changing stock for me. For those who don't know, ZIM IPO'd at $15, fell to 11 the first day. In the first year of trading alone, the dividends were almost double the IPO price. So just a phenomenal investment return for us. ZIM right now, ever since about April-ish, I've cooled on ZIM. I currently have a long position as we're speaking. It's more of a trade. But I've cooled on ZIM a little bit because the risk reward is not quite as strong as it is for companies like Global Ship Lease, that top pick we just mentioned. The reason why is because ZIM is 100%, well, not 100%, but basically about 80% focused on the spot market, which changes day to day, week to week. And they have about 20% contracts on 1 year duration. So it's a lot of exposure to the present market. And there's really not much visibility on how 23, 24, 25 is going to look. Whereas with global ship lease, I know almost exactly how 23, 24, and 25 are going to look, and it's going to look great. So that's why, even though I have a long trade in Zim, I'm not really, it's not really the risk reward that it used to be.
Excellent. We've got time for one more question. What about the bleak macro environment for dry bulk, but the favorable order book and upcoming regulations? How do you feel about the current valuations in the dry bulk space?
Yeah, that's a fantastic question. Look, I think if you get into dry bulk, you get into the right stocks and the right companies and the right investments. I think you're going to do very well if you have patience, if you can hold on for a couple of years, 2-3 years. Maybe it'll be faster, but I don't know for sure. What you want to do if you're going to invest in something like dry bulk that is challenged, you want to pick companies with solid management teams that you can trust, and you want to find balance sheets that are going to be able to survive. Say the next 6 months are weak. You want to find companies that are going to have no issues with that. And that's why it was so easy for me to suggest Genco Shipping. And I personally actually do not have a current long position in Genco. I just think it's a good setup for somebody who wants to get into dry bulk, but wants to have a margin of safety, because that balance sheet is rock solid and that corporate governance is really good.
Excellent. Well, unfortunately, that is all the time we have for today. Jay, it's an absolute pleasure to have you back on the Money Show stage. We really appreciate it. I'll leave the closing remarks to you.
All right. Thanks, everybody, for taking time out of your morning to join us. We'll do this about once a quarter, so hold me accountable next quarter. We'll see how we do. And we do have 2-week free trials available, mintzmeyer.com, and those are open until Friday. Thanks, everybody.
Thanks so much, Jay. Have a great one.